Welcome to The Explainer. Today, we're diving into a genuinely fascinating paradox that is playing out right now in the Korean stock market. Picture this. On one hand, you've got tech sectors that are absolutely blasting off, right? Hitting new highs practically every day. But then, on the exact same market, there's an entire sector of incredibly profitable, globally dominant companies that are watching their stock prices absolutely tank. It's wild. It's a massive disconnect, a real market mystery. We're going to unpack exactly why this decoupling is happening, what is really going on beneath the surface, and why some analysts are literally calling this a historic buying opportunity.
Okay, let's dive into this. If you look at the broader KOSPI and KOSDAQ indices right now, they're in the middle of a massive boom. And you know, it's driven almost entirely by this explosive growth in AI infrastructure, semiconductors, NPU and GPU tech, the whole shebang. Liquidity is just flooding into these tech names at an unprecedented rate. But in stark contrast, the SOL Medical Device ETF, which tracks the top healthcare and medical device companies, has been plummeting. We're talking dropping all the way down to the 9,500 KRW level. So we're looking at a severe decoupling here. The overall market is surging, but this specific ETF is heading in the exact opposite direction.
So, to figure out why, let's look under the hood. The top holdings of this ETF are absolute heavyweights in the industry. We're talking Hugel, Classes, LNC Bio, Meditox, and Pharma Research. Now, seeing those names drop, you might reasonably assume, hey, if the ETF is tanking, these businesses must be struggling, right? Well, actually, scratch that. It's the exact opposite. These companies are pulling in record-breaking revenues. What we're witnessing here isn't a fundamental failure at all. These companies are basically just the victims of a massive sector rotation. Institutional and foreign money is just draining right out of the steady healthcare sector because everyone's chasing those massive immediate returns in the AI boom.
There's also another macro factor pushing these stocks down right now. Global regulators, like the FTC over in the US, have really stepped up their scrutiny lately to block market monopolies. This has put a huge chill on those mega M&A deals. You know, the massive market-shaking acquisitions that investors usually go crazy for. Because of that chill, the market is pivoting to what we call tuck-in M&A strategies. These are much smaller, highly strategic acquisitions designed to grab very specific tech or product lines. For investors, it basically means the short-term speculative hype is gone. And that leaves these highly profitable stocks stuck trading at a massive, albeit temporary, valuation discount.
To prove that this discount isn't actually justified by the business fundamentals, we're going to break this journey down into 4 core pillars. Number 1, aesthetics, the margin kings. Number 2, toxins, K-Bio's global return. Number 3, biomaterials and dental growth. And finally, number 4, the time lag opportunity.
Section 1, aesthetics, the margin kings.
And this brilliantly illustrates the genius business model behind the biggest players in the energy-based device space. It's known as the razor and razor blade model. You know the drill, right? You buy a razor handle for practically nothing, but then you spend a small fortune over the next few years on replacement blades. We've all felt that pain at the drugstore. Well, companies like Classes are doing the exact same thing, just with medical-grade equipment. They sell their high-tech aesthetic machines like ultrasound or radiofrequency devices to clinics for a relatively low upfront cost. But once that clinic has the machine, they have to keep buying the proprietary cartridges and consumables for literally every single patient they treat. It generates a massive, recurring, and incredibly high-margin stream of cash.
Because of this brilliant model, Classes currently boasts a mind-blowing operating margin of around 50%. Just take a second to let that sink in. Literally half of every single dollar they make is pure operating profit. That is an absolute powerhouse of a metric. And yet, if you pull up their stock price, it's basically just been trading sideways, totally disconnected from that massive fundamental strength.
Let's move to and see how this builds when we compare the top players, because it shows just how strong this trend really is. Classes is absolutely dominating markets out in Brazil, Latin America, and Southeast Asia with their HIFU tech. And then you have Wantech, who is rapidly scaling their margins up to around 30% and locking down really strict regulatory approvals to expand into the US and Europe. Both of these powerhouses are achieving massive, tangible global expansion as we speak. They're proving that their underlying businesses are completely insulated from all the AI macro gloom. This is real global growth.
Section 2, toxins, K-Bio's global return.
Now wrap your head around this number, 176.2%. That is the year-over-year export explosion that Hugel just recorded in the first quarter out of their Chunshan manufacturing base. I mean, they exported over $17 million worth of product in a single month. This absolutely proves that the cash printer for these companies isn't just working, it is fully operational, running white hot and being driven by explosive global demand.
When we group these three giants together, Hugel, Meditox, and Daewoo, a really clear picture starts to emerge. See, for years, this specific subsector was bogged down by really complex intellectual property lawsuits, lots of litigation risk. But those risks, they're basically gone. Meditox is right in the middle of a massive turnaround phase after clearing their legal hurdles, and they're gearing up for huge US and European orders. Daewoo is seeing their North American orders surge via their partner Evolus, and Hugel, like we said, is posting 40 to 50% margins. Yet, because of that broader market rotation we talked about, all three of these companies are currently sitting at what analysts are calling extreme deep value territory. The market literally just hasn't priced in their clean slates and these surging exports.
Section 3. Biomaterials and Dental Growth.
Now, what's really interesting about this slide is the incredible diversity of their economic moats. Take pharma research, for instance. Their core tech actually involves extracting specific DNA fragments from salmon, yes, salmon caught off the East Coast, to create highly effective skin boosters and joint injections. I know, salmon DNA for skincare sounds totally sci-fi, but guys, it really works. And because they completely own their supply chain, from catching the fish to packaging the final medical product, they pull in a massive 35% operating margin and consistently post earnings surprises. You've also got LNC Bio dominating human tissue grafts, and BioPlus securing high 40% margins with their premium filler tech. These aren't just cool concepts, these are highly profitable realities.
And then you've got the dental sector, heavily anchored by Dentium. There's been a lot of market fear lately about China, specifically around their volume-based procurement, or VBP policy. Basically, this policy forces down the unit price of medical devices. Sounds bad, right? Well, Dentium's brand is so incredibly strong that the sheer volume of implants they're selling in China is skyrocketing, which completely offsets the drop in individual prices. By using a direct sales model that heavily locks in physicians through hands-on training, they are consistently crushing it globally. They're holding operating margins above 30%, even with all those macro fears swirling around.
Section 4. The time lag opportunity.
So, the crucial point is this. What we are seeing here is a textbook example of a time lag, and this is exactly why looking past the daily noise of the market is absolutely crucial. This severe disconnect between the plummeting ETF price and the record-breaking margins of these K medical device companies, it's not a structural failure. It is entirely driven by a temporary liquidity shift over to AI, along with that transition in global M&A strategies we discussed. The fundamentals of these businesses are soaring, but the stock prices are just lagging behind. And if history tells us anything, the market always eventually catches up to the fundamentals.
Which leaves us with a really critical question. When this current AI hype eventually stabilizes, and it will, and capital starts rotating back into companies that have actual 30 to 50% operating margins and triple-digit export growth, where's this sector going to be? The data strongly suggests we're looking at the potential for an explosive re-rating and massive M&A action for K medical devices. So, will you let this time lag pass you by, or will you capitalize on the decoupling? Thanks so much for joining me for today's explainer, and as always, keep your eyes on the data.